And let's also, as Talbot said, let's recognise that this is a good subject to discuss when rates rise. This is about an environment in which central banks are having to respond to growth. The US Fed is having to respond to growth in the world's economic engine, and that's however we come to think about global financial stability, that has to be a huge positive that we will be taking into account. So why, at the end of a discussion, a long and interesting discussion on monetary stability, are we now thinking about financial stability in this, what from Europe seems a far-off vision of rising rates? And I was thinking about this. I was struck by a conversation I had in Latin America a few months ago. We were talking to a very senior central banker, and we asked him at the end of the conversation what he saw as the main threats to growth globally and also in Latin America. And there were any number of answers I thought he might come up with. He thought very long and deeply about it, and finally looked up and said, Scotland, which was a surprise. I hadn't expected Scotland to be top of his list. His logic was that what damages Europe damages the world, and the potential for the less solid integration, the disintegration of the political consensus across Europe is something which damages Europe. Why was I surprised? I thought he was going to talk about tapering, about financial flows, about rising US interest rates, because for all of the time that we spent today talking about the prospects of QE in Europe and low interest rates, for most of the world's population, it's the prospect of rising interest rates clearly in the US that present more pressing concerns. And the question fundamentally is we've had QE1, QE2, QE3, we're going to have taper tantrum 1, 2 and 3 as well. And more importantly, are those tantrums, if they materialise, likely to cause serious financial instability in large parts of the world's economy? And I think the answer from me is that they should not, they need not, although clearly they could. I think just harking back to two of the themes that we picked up on time and time again, one in particular over the course of today. One is communication, and the other is the primacy of domestic policy. I think that was a point that Adam made in a slightly different context early on. The importance of domestic policy for the outcomes for the world's financial system and for the world's economy. And I think it's important to bear those two themes in mind because they're directly relevant to the prospects for financial instability as the Fed starts to taper. There clearly is a common perception, expectation, fear that US normalization could cause financial instability. And whatever the underlying reasons for that, whatever the rationale, whatever the reasonability, that in itself is a concern because perception, expectation, and fear are insidious. They're difficult to address. They can create self-fulfilling prophecies, the forward-looking shadow of which we've already seen in a couple of taper tantrums, and which have the potential to destabilize economies around the world. Disparate economies, the fragile five, a peculiarly disparate selection of countries with very little in common other than a certain alliterative attraction. But it's that kind of perception that policymakers will be struggling with and that will lie at the base of whether we will in fact see any kind of financial instability. And I think, again, the communication challenge that we talked about, the Fed in particular, policymakers generally, but in this particular instance, the Fed in particular, the clarity of its communication over its objectives and its modalities. Krishna talked about the two rules, which are clearly an objective fact. They're a challenge that the US authorities, the Fed, need to deal with. They have two rules. That means that their policy objectives can change quite quickly in over a short period of time. That makes their life difficult. It makes life doubly difficult for investors who are trying to anticipate the future course of US monetary policy. The importance of domestic policy. And by domestic policy, I don't mean in the US. I mean in India, in Indonesia, in South Africa, in Turkey, in Brazil, Russia, etc. The strength of the domestic policy environment and the flexibility of that environment. How fit is it for use, and how is it used? The answer to the question, can we expect to see financial instability as a consequence of normalization, will depend very much on the quality of communication and the quality of policy formulation. Because remember, investors' fears, their perceptions can be well founded. We know that in an environment of rising rates, There is a significant. The logic follows very neatly from rising rates through highly leveraged household sectors, corporate sectors, financial sectors, to distress, in particular in the financial sector, with all the instability consequences that can bring. Especially where, and those are what you might call fundamental factors, especially where what you might call financial factors, investor risk aversion, rising risk premia, reversion in capital flows can make the policy problems facing governments in those countries and the liquidity challenges facing the financial sectors in those countries, they can exacerbate them. That combination of fundamental weakness and financial motive forces can indeed create financial instability, which again can be insidious, and we've seen many times over recent years the potential for contagion. It's important, though, to bear in mind two things. Again, get back to the basics. This is a good environment that we're seeing this in. This is an environment in which the US economy is presumably growing, global trade is therefore burgeoning. Economies, countries in emerging markets which are dependent, in Asia, for example, on trade will be benefiting from that. So they will be fundamentally in a good global environment. Moreover, we're not seeing, if we're thinking about what can drive fundamental weaknesses in financial systems and economies, leverage across sectors, illiquidity across sectors, we don't see that as a ubiquitous phenomenon across emerging markets. Again, I think one of the things that's said time and time again, and needs to be said time and time again, on a fundamental basis, there is no emerging market problem. There are a few emerging markets which have problems. And I think that is something which we will see, but it's an important lesson to bear in mind. The fundamentals generally across the emerging markets are a lot stronger than they are in Europe, for example. So that leaves authorities around the world, domestic authorities and the US authorities, dealing with this potential financial instability, the financial driver of instability. How do they do that? Again, we're seeing they do it partly by maintaining strong policy environments. There was a point made earlier on from the lady at the Asian Development Bank, I think, about the changes that have been made over the past 10 years to improve fundamentals across the emerging markets. We see very few twin deficits, many more surpluses, high savings rates. There are very few economies which are dependent on external debt, anything like the degree that was true 10 years ago. Flexible exchange rates, of course. Even where, across Latin America, for example, you see current account deficits, they're often financed by direct investment, not by portfolio flows. The fundamentals have been put in place there by policymakers, and how policymakers maintain those fundamentals will be a fundamental driver. We saw this, again, with the so-called Fragile Five over the past couple of years. What has been interesting is not that those five were singled out, but the very strong policy responses in some of those countries, which effectively helped address the perception problem amongst investors. So the challenge for policymakers in the US and elsewhere will be threefold: to avoid generalized instability by managing the financial impact, financial perception, the rise in risk premia through communication and effective deployment of domestic policy. And the important point is that is within their control. It's within the US authorities' control to try to communicate effectively and clearly future target interest rates, notwithstanding the challenges they face from their bifurcated objectives. It is within the control of domestic authorities across the emerging markets to continue the strong policy response, not ubiquitously, but in many, many emerging market countries, to reversals in financial flows that we've seen over the past, to occasional reversals that we've seen over the past year. So what will we see? We will see shocks, we will see instability. Will we see generalized financial instability? No. Will we see particular instances of financial instability, of economic instability in the more exposed amongst the emerging markets? Quite possibly, but that will depend on policy leaders.